And in our top business story, business activity growth in the UAE's non-oil private sector fell in November from October's record high, as new orders and output slowed sharply, according to the latest survey. The HSBC UAE Purchasing Managers Index measures the performance of the manufacturing and services sectors, where the 50 mark separates growth from contraction. Although the index fell to 58.3 points in November from 61.2 in October, it remained above the 50 mark, and the rise recorded in October was the highest level ever recorded since the series began back in 2009. Officials were quoted as saying that the score is down only from its very high base and remains firmly in expansionary territory. We remain upbeat on near-term growth prospects in both Dubai and Abu Dhabi. UAE firms saw output growth fall to 62.8 points from an all-time high of 66.1 points in October, while new orders growth fell to 65.5 points in November from 69.9 in the previous month, also the highest level on record. Dubai Parks and Resorts has successfully closed the UAE tranche of its 2.5 billion dirham initial public offering. According to a statement, the Dubai Parks and Resorts shares are expected to be listed on the Dubai financial market on the 10th of December this year. The UAE tranche will comprise 40% of the shares on offer in the IPO, with the remaining 60% having been allocated to the qualified institutional tranche. It added that the UAE tranche order book was oversubscribed multiple times at the offer price of 1 dirham per share. Rayed Al Nuaimi, the CEO of Dubai Parks and Resorts, was quoted as saying that the strong response we have seen from retail investors to our IPO is a testament to the ambition of what we are building, a premier year-round global entertainment destination which will attract visitors from around the world to Dubai. Companies in the Middle East and North Africa raised 35.2 billion dirhams through 21 initial public offerings in the first 11 months of this year. That's according to the latest study. According to the report by Global Investment House, this has been the market's best performance in terms of proceeds after the 2008 economic downturn, when it raised 45.5 billion dirhams from 45 issues. It added that the average deal size in 2014 was significantly higher than that of 2008 by 66%. Company officials stated that they expect the momentum to continue, driven by the MSCI's upgrade of the Qatar and UAE to emerging markets, the liberalisation of the Saudi stock market, sustained investment in developing social infrastructure, and capacity building to host upcoming global events such as the Expo 2020 in Dubai. Improved valuations, upbeat fundamentals of the MENA region, as well as relaxed regulatory norms are key catalysts, which would continue driving equity markets, boosting the IPO activity in 2015, with the GCC countries in the lead. In the last few months, the IPO market witnessed intense activities. 30.46 billion dirhams, mainly led by National Commercial Bank and the MR Malls Group. The majority of lead arrangers and investors expect a boost in Sukuk issuance in 2015 to be between 150 and 174.9 billion US dollars. That's according to the latest report. Thomson Reuters announced its 2015 findings of annual Sukuk perceptions and forecast report at the 21st Annual World Islamic Banking Conference, where 44 lead arrangers and 106 investors were surveyed in August and September this year. Some of the findings show that total global outstanding Sukuk stands at 241 billion US dollars, with around 110 billion issued in 2014, which is expected to grow to 907 billion US dollars by 2020. Additionally, for the first 9 months of 2014, 19 jurisdictions tapped the Sukuk market, the highest number in the market's history. Investors view the UK as the most attractive emerging Islamic finance market for Sukuk investment, while lead arrangers also expect that more Sukuk is to be issued from the UK. Officials were quoted as saying that critically they are seeing increased support from governments. However, a number of challenges that limit the growth of the sector need to be solved, including transparency, standardisation and liquidity in the secondary market.